There is a moment in every great financial panic, a single point in time where the world seems to be ending. It's a moment of pure, undiluted fear. The headlines are screaming, the experts are predicting Armageddon, and every fiber of your being, every instinct honed over 1,000,000 years of evolution, is telling you to run for the hills, to sell everything, to get out before it all goes to zero. This is the moment of maximum pessimism. It is the moment where fortunes are lost by the many, and the moment where generational wealth is forged by the very, very few. For most, this point of peak panic is a wall of fire. But for Warren Buffett, it has always been a doorway. His entire career, a monument to the power of rational thought in an irrational world, has been built not on predicting rain, but on bringing an ark when the floodwaters are already rising. He has mastered the art of running toward the fire, of buying when there is blood in the streets, of transforming widespread catastrophic fear into personal, life-altering profit. This is not a strategy for the faint of heart. It is the ultimate expression of contrarian investing, a discipline that requires an iron gut, a clear mind, and a deep understanding of the difference between a temporary crisis and a terminal illness. Today, we are going to dissect this very principle. We are not just going to talk about a vague idea of buying the dip. We are going to dismantle the mental machinery of a master piece by piece and give you the intellectual tools to see what he sees, to do what he does. You will learn to see industry-wide crises not as a reason to flee, but as a potential source of incredible, once-in-a-generation bargains. This is a masterclass in financial psychology and a blueprint for a CEO mindset, a way to approach your portfolio strategy with the cold, calculated calm of a leader making a critical executive decision-making call under fire. We will explore how to find the hated stocks, the abandoned assets, and the hidden gems buried under the rubble of a market crash, allowing you to acquire high-quality businesses when they are being sold for pennies on the dollar. This is the path to beating the market, and it begins by understanding the anatomy of a true crisis opportunity. The first and most critical pillar of this entire philosophy is learning to accurately diagnose the nature of the crisis itself. Not all fires are the same. Some are contained within a single room, some will burn a building to the ground, and others are wildfires that will reshape the entire landscape. An investor who cannot tell the difference is just a gambler, and gamblers over the long run always go broke. The art of crisis investing lies in separating a temporary, solvable problem from a permanent, fatal flaw. It's about understanding when a great industry is simply sick, versus when it is truly dying. To truly grasp this concept, we must travel back in time to 1963, to a scandal so bizarre, so audacious, that it threatened to bring down one of America's most iconic financial institutions. The story is known as the Salad Oil Scandal, and the company at its heart was American Express. At the time, American Express was a titan, but not for the credit cards we know today, which were still a nascent part of their business. Their fortress was built on travelers, checks, the de facto global currency for tourists, and, crucially for our story, its warehousing division. This division, known as American Express Warehousing, would inspect and certify inventory for other companies, issuing warehouse receipts that those companies could then use as collateral for bank loans. It was a simple, profitable business, built on the bedrock of American Express's pristine reputation for trust. The villain of our story is a man named Anthony Tino DeAngelis. He was a flamboyant, larger-than-life character, a commodities trader from the Bronx who cornered the market on salad oil. Or, more accurately, he made it seem like he had. DeAngelis ran the Allied Crude Vegetable Oil Refining Corporation, and he used American Express's warehousing unit to certify his inventory. He convinced banks to lend him over $150 million, an astronomical sum in 1963, equivalent to well over $1 billion today, against warehouse receipts for his vast stockpiles of salad oil, which he stored in massive tanks in Bayonne, New Jersey. The problem was, the tanks weren't full of salad oil. They were mostly full of seawater. DeAngelis had devised a clever system where a thin layer of valuable salad oil floated on top of worthless water. When inspectors from American Express would dip their rulers into the tanks, they'd pull them out coated in oil, and none the wiser would certify the receipts. It was a fraud of breathtaking simplicity and scale. In November 1963, the House of Cards collapsed. DeAngelis's company defaulted on its loans, and the truth came out. The banks, holding worthless receipts for tanks of seawater, were on the hook for millions. And because those receipts were certified by American Express, the banks and the entire market turned on Amex. The logic seemed simple and brutal. American Express had guaranteed the inventory. The inventory was a phantom. Therefore, American Express was liable for the entire $150 million in losses. Wall Street panicked. The stock, which had been a blue-chip darling, plunged. It fell almost 50% in a matter of weeks. The narrative was set, the headlines were vicious. American Express was finished. The world's most trusted financial brand had made a catastrophic, potentially fatal error. This was the moment of maximum pessimism. Every analyst, every pundit, every professional in wealth management was screaming, "Sell!" This was the very definition of a hated stock, caught in the eye of a storm. But in Omaha, Nebraska, a young Warren Buffett saw something different. He didn't see a dying company. He saw a great company with a very big but very specific problem. He began a process of investigation that is a perfect illustration of how to dissect a crisis. He didn't just read the headlines or listen to the noise. He did what he always does. He went out and did the legwork. He started by asking a fundamental question. Has this scandal, as terrible as it is, damaged the core money-making engines of American Express? He wasn't interested in the warehousing division, which he correctly identified as a small, peripheral part of the overall business. He was interested in the travelers, checks, and the credit card business, so he started visiting restaurants and hotels. He'd talk to the cashiers and managers, asking if customers were still using their American Express cards. He would go to banks and talk to tellers, asking if people were still buying American Express travelers, checks. The answer, everywhere he went, was a resounding yes. The public, the actual customers using the products, either didn't know about the salad oil scandal or they didn't care. The fraud was an esoteric Wall Street affair. It hadn't shaken the consumer's faith in the brand. The brand, the true source of the company's value, was intact. Then he did the financial analysis. He spoke with lawyers and experts to understand the true legal liability. He concluded that while Amex would surely face lawsuits and take a hit, the ultimate liability would be far, far less than the catastrophic $150 million the market was pricing in. The market was panicking, assuming the absolute worst-case scenario. Buffett, through calm, rational analysis, realized the probable outcome was much more manageable. He saw that the market had wiped out hundreds of millions of dollars in market value from a company that was still gushing cash from its core operations, all because of a problem in a tiny, non-essential division. The market was confusing a deep cut on the arm for a fatal wound to the heart. This was his signal. He famously plowed 40% of his partnership's capital, a massive, career-defining bet, into American Express stock, buying it up as the panic sellers dumped it. Over the next few years, as the company settled the lawsuits for a fraction of what the market had feared and its core businesses continued to grow, the stock soared. The investment was a grand slam, solidifying his reputation and providing the capital that would fuel his future empire. He saw a crisis opportunity, and he seized it. The psychological principle at play here is a powerful and dangerous combination of herd mentality and the availability heuristic. Humans are social creatures. When faced with uncertainty and fear, our deep-seated instinct is to look at what everyone else is doing and follow along. In the prehistoric savanna, if everyone suddenly started running, you didn't stop to ask why. You ran too. The person who stopped to analyze whether it was a lion or just the wind was eaten. This instinct is still wired into our brains. When the market is crashing and every headline blares sell, our brain screams at us to join the herd. To stand apart, to buy when everyone is selling, feels unnatural and terrifying. It goes against our very programming. The availability heuristic compounds this problem. This cognitive bias describes our tendency to overestimate the likelihood of events that are more recent, more memorable, or more emotionally charged. The salad oil scandal was a dramatic, vivid, and shocking story. It was easily available to everyone's mind. The slow, boring, day-to-day profitability of travelers, checks, and credit card swipes was not. The market, therefore, fixated on the dramatic, available information, the scandal, and completely ignored the far more important but less exciting data about the core business's health. Buffett's genius was in consciously overriding these two powerful biases. He ignored the herd and deliberately sought out the less available, less dramatic information by physically going to businesses and observing customer behavior. He forced himself to see the whole picture, not just the sensational headline. This is a core discipline of financial psychology, recognizing that the market's mood is often driven by the most emotionally resonant story, not the most financially relevant facts. Beating the market is often a matter of being the most rational person in a room full of hysterics. So how can we translate this into a practical, repeatable process? How can you or I, when faced with a similar crisis, apply this CEO mindset to our own capital allocation? We can create a mental model, a blueprint for dissecting a crisis. Let's call it the salad oil test. It consists of 4 distinct steps. Step 1. Isolate the wound. You must first identify the precise source of the crisis. Is it a company-specific issue like the Amex fraud? Is it an industry-wide problem like the 2008 banking crisis? Or is it a broad macroeconomic event like a pandemic or a recession? You have to be a doctor diagnosing a patient. You can't prescribe a treatment until you know exactly what the illness is. Step 2. Assess the damage to the core. This is the most crucial step. You must ask, does this wound threaten the long-term earning power of the core business? For Amex, the warehousing fraud did not affect the public's desire to use their credit cards. For a newspaper company in the age of the internet, the crisis of declining readership and advertising revenue was a direct blow to the heart of the business model. One is a temporary problem, the other is a terminal decline. You must be brutally honest in this assessment. Step 3. Differentiate the headline from the balance sheet. The media's job is to sell stories, and fear sells best. You have to ignore the narrative and focus on the numbers. Look at the company's balance sheet, its debt levels, its cash flow. Can it financially survive the crisis? Does it have the resources to weather the storm, pay the fines, or outlast the recession? Buffett saw that Amex, despite its legal troubles, was a financial fortress. Many companies entering a crisis are not. Step 4. Quantify the panic. The final step is to measure the market's overreaction. Calculate how much market capitalization has been lost, and compare that to your realistic assessment of the total financial damage from the crisis. In the Amex case, the market wiped out a value far exceeding the worst-case legal liability. The difference between the market's panic price and the rational value of the business, accounting for the crisis, is your margin of safety. It's the source of all extraordinary investment opportunities. Now let's explore the opposite approach, the path that 99% of investors take, which almost always leads to ruin. This is the path of the antithesis. The most common mistake is failing to differentiate between a crisis and a fundamental disruption. The amateur contrarian, armed with the simple mantra, "buy when there's blood in the streets," often ends up catching a falling knife. They see a stock that has fallen 90%, like Blockbuster Video in the mid-2000s, and think it's a bargain. They apply the salad oil test and fail spectacularly. What was the crisis for Blockbuster? The rise of Netflix and digital streaming. Did this threaten the core business of renting physical DVDs from brick-and-mortar stores? Yes, it obliterated it. It wasn't a temporary problem. It was a technological shift that made the entire business model obsolete. Yet, countless investors bought Blockbuster stock all the way down to zero, thinking they were being clever contrarians. They were confusing a cheap price with a good value. A cheap stock can always get cheaper. The second major mistake is what we can call headline investing. This investor does the opposite of Buffett. They don't do the legwork. They simply react to the news. When the headlines are good, they buy. When the headlines are bad, they panic sell. They are perpetually whipsawed by the market's emotions, always buying high and selling low. They are the ones who sold American Express in 1963, who sold bank stocks in 2008, who sold everything in the COVID crash of March 2020, only to watch in agony as the markets roared back without them. Their portfolio strategy is dictated by fear and greed, the two most expensive emotions an investor can have. They are not engaging in value investing, they are engaging in emotional reaction. This path leads to a slow and certain erosion of capital, a constant state of anxiety, and ultimately, the failure to achieve any meaningful financial goals. The direct financial connection here is profound and can be seen clearly on the balance sheet and in your portfolio returns. When you correctly identify a temporary crisis in a great business, you are essentially getting two things for the price of one. First, you are buying the company's future earnings stream at a massive discount. The market, in its panic, is pricing the company as if the crisis will last forever. Your rational analysis tells you it won't. This gap between perception and reality is pure profit potential. When the crisis subsides and earnings return to their normal trajectory, the stock price doesn't just recover, it often overshoots as optimism returns. Second, you are minimizing your risk. This sounds counterintuitive. How can buying a hated stock in a crisis be less risky? The answer lies in Buffett's famous concept of the margin of safety. When you buy a wonderful business for 50 cents on the dollar, you have a huge cushion against being wrong. If your analysis is slightly off, if the recovery takes longer than you expect, you still have a high probability of making a decent return. But if you are right, your returns can be astronomical. This isn't just about stock picking. It's about a fundamental shift in your entire portfolio strategy. Instead of chasing momentum and buying what is popular and expensive, you are hunting for value where it is most abundant, in the midst of fear. This approach systematically tilts the odds in your favor. It transforms market volatility from a source of terror into a source of opportunity. This mindset, this ability to dissect a crisis and act rationally when others cannot, is the foundational skill that separates amateur speculators from professional capital allocators. It is the first and most important step on the path to turning market crashes into personal fortunes. Before you can even begin to think about buying into a crisis, before you can analyze a balance sheet or contemplate going against the herd, you must have the one resource that is scarcest in a panic: capital. The greatest investment opportunities in the world are utterly useless to an investor who has no money to deploy. This brings us to the second pillar, a principle that is less glamorous than daring contrarian bets but infinitely more important. The fortress balance sheet imperative. Warren Buffett's ability to act decisively in moments of extreme fear is not born from spontaneous courage alone. It is the direct result of a lifelong, disciplined, and often painfully patient strategy of maintaining a massive reserve of cash. He treats cash not as a lazy, underperforming asset, but as a strategic weapon, a call option on future chaos with no expiration date. To understand the raw power of this principle, we need to examine the moment of greatest modern economic fear, the financial crisis of 2008. As the summer of 2008 turned into autumn, the global financial system was teetering on the brink of collapse. The subprime mortgage crisis, which had been simmering for over a year, had exploded into a full-blown inferno. In September, the investment bank Lehman Brothers, a 158-year-old institution, declared bankruptcy, sending shockwaves through the entire system. Credit markets froze solid. Banks stopped lending to each other. The lifeblood of the economy, credit had ceased to flow. The government was scrambling with bailouts, and the stock market was in a state of freefall. It felt like the end of the world. For almost every CEO, investor, and financial institution, the primary concern was survival. Their balance sheets were stretched, they were over-leveraged from the boom years, and now they were facing a liquidity crisis of epic proportions. They were forced to sell assets, any assets, at fire sale prices, just to stay solvent. They were players forced to fold a winning hand because they didn't have enough chips to stay in the game. But in Omaha, Warren Buffett was in a completely different position. For years, during the housing bubble and the private equity boom of the mid-2000s, he had been criticized. Pundits and analysts chided him for being too conservative, for sitting on a growing mountain of cash within Berkshire Hathaway's treasury. While others were using cheap debt to make ever larger and more aggressive acquisitions, Buffett was sitting on the sidelines, complaining that prices were too high. Berkshire's cash hoard swelled to over $40 billion. It was a drag on the company's reported returns. Many shareholders grew impatient. They were suffering from a severe case of FOMO, the fear of missing out. As they watched other stocks and companies soar, Buffett's response was simple and unwavering. "We will not be a source of funds for the financial system. We will be a source of strength." He was building an ark, and he was happy to look foolish while the sun was shining. Then, the flood came. In the terrifying weeks following the Lehman collapse, when capital was the most valuable commodity on the planet, Warren Buffett's phone started ringing. On one end of the line were the titans of Wall Street, the very same masters of the universe who had been leveraging up and taking massive risks just months earlier. Now they were coming to Omaha hat in hand, not for a bailout but for a seal of approval and, more importantly, for capital. First came Goldman Sachs. On September 23, 2008, with its stock price plummeting and its short-term funding in jeopardy, CEO Lloyd Blankfein negotiated a deal with Buffett. Berkshire Hathaway would invest $5 billion in Goldman. But the terms were breathtaking. Buffett didn't just buy common stock. He bought $5 billion of perpetual preferred stock that paid a guaranteed 10% annual dividend. That's $500 million a year, every year, just for showing up. On top of that, he received warrants to buy another $5 billion worth of common stock at a fixed price. It was an incredibly lucrative deal, a Buffett premium that only he could command because he was the only one with both the cash and the credibility to calm the markets. Just a few weeks later, he did it again. General Electric, a bedrock of American industry, was in trouble. Its massive financing arm, GE Capital, was struggling to roll over its commercial paper. Buffett swooped in again, investing $3 billion in GE preferred stock, also with a 10% dividend and warrants. Then came Bank of America, which needed a capital injection after its troubled acquisition of Merrill Lynch. Buffett invested $5 billion under similarly favorable terms. He wasn't just buying the dip in the open market. He was acting as a lender of last resort, a private Federal Reserve, and was being compensated handsomely for it. He was not a passive investor. He was an active capital allocator at the highest level. These deals weren't luck. They were the culmination of years of financial discipline. He had the cash ready because he had refused to overpay during the bubble. He had the patience to wait for what he called the fat pitch. When the 2008 crisis arrived, it wasn't just a fat pitch. It was the entire World Series of fat pitches, and he was the only player on the field with a bat. The profits from these deals for Berkshire Hathaway were staggering, eventually running into the tens of billions of dollars. It was a masterclass in turning a fortress balance sheet into an engine of immense profit. The underlying psychological principle that makes this discipline so difficult for most people is called hyperbolic discounting. This is our brain's powerful, innate tendency to prefer smaller, immediate rewards over larger, delayed rewards. The further away a reward is, the less we value it. An economist would say we discount its future value. This is why so many people struggle to save for retirement. The immediate pleasure of spending $100 today feels much more compelling than the abstract benefit of having several $100s in 30 years. In investing, this bias manifests as a chronic impatience. Holding cash feels unproductive. It earns next to nothing. Meanwhile, we see other stocks, cryptocurrencies, or real estate ventures soaring in value. This triggers the pain of missing out, or FOMO. Our brain tells us that every day we hold cash, we are losing potential gains. It's a constant, nagging pressure to do something with our money, to put it to work right now. Buffett's strategy is a direct assault on this cognitive bias. He mentally reframes the purpose of cash. For him, cash is not a zero-yield asset. It is a high-value strategic asset, whose value is not in the interest it earns, but in the options it provides. It is the price of being able to sleep well at night, and the ticket to play the game when everyone else has been forced to leave the table. This requires a long-term perspective that is almost superhuman, a willingness to underperform for years in order to have the firepower to massively outperform when it matters most. It's a CEO mindset applied to a portfolio, prioritizing long-term strategic advantage over short-term tactical gains. How can we institutionalize this discipline in our own financial lives? We can create a practical mental model, a blueprint I call the dry powder protocol. It is a systematic approach to building and deploying crisis capital. Step 1. Quantify your fortress. You must decide, in advance, what percentage of your investment portfolio will be dedicated to dry powder. This isn't your emergency fund for life events. This is your market opportunity fund. For some, it might be 10%. For a more conservative investor like Buffett, it might be significantly higher. The key is to define it and write it down. This capital should be held in the safest, most liquid instruments: treasury bills, a high-yield savings account, or a money market fund. Step 2. Establish rules of engagement. This is critical. You must define the specific conditions under which you will deploy this capital. These rules must be simple and unambiguous, designed to remove emotion from the decision. For example, I will deploy 25% of my dry powder when the S&P 500 closes 20% below its all-time high. I will deploy another 25% if it falls to 30% below, and so on. By pre-committing to a plan, you are taking your future, panicked self out of the equation. Step 3. Automate the accumulation. Building a cash reserve is a marathon, not a sprint. The most effective way to do it is to make it automatic. Set up a regular, recurring transfer from your checking account to your dry powder fund. This turns the painful decision of saving into a non-decision, a background process that works silently to build your fortress. Step 4. Reframe the asset. This is the psychological component. You must stop thinking of your cash reserve as a drag on performance. Instead, you must learn to see it as Buffett does, as a call option on opportunity. It is the most valuable tool in your risk-taking arsenal. Every dollar in that fund represents a piece of a future bargain, a share of a great company that you will one day buy from a panicked seller at a ridiculous discount. The antithesis to this disciplined approach is what I call the fully invested fallacy. This is the path of the 99%, a dogma preached relentlessly by many financial advisors and market commentators. The argument is that time in the market beats timing the market, and therefore, you should be 100% invested at all times to capture every bit of upside. They will show you charts proving that missing the 10 best days in the market over 20 years would decimate your returns. While mathematically true, this advice is psychologically and practically flawed for most people. The investor who is fully invested, and often leveraged on top of that, is incredibly fragile. They have no resilience. When a market crash inevitably occurs, they are exposed in two devastating ways. First, if they have any leverage, such as a margin loan, they can be subject to a margin call, forcing them to sell their holdings at the absolute worst possible time to cover their debt. They become forced sellers at the bottom. Second, and more commonly, they are rendered completely powerless. They watch as the greatest bargains of a decade float by, but they have no capital to deploy. Their only option is to hold on and hope for a recovery. They are passengers on the roller coaster, not the operators who can choose when to get on and off. They participate in the terrifying downside and are then unable to aggressively capitalize on the opportunities the downturn creates. This approach completely misunderstands the nature of risk-taking. True risk management isn't just about diversification. It's about having the liquidity and the emotional stability to act when opportunities are greatest, which is precisely when risks seem highest. The direct financial connection between a fortress balance sheet and superior returns is crystal clear. Look at the terms of Buffett's 2008 deals. He received preferred stock with a 10% dividend. At a time when Treasury yields were approaching zero, he was locking in a guaranteed, bond-like return that was multiples of the risk-free rate. This income stream alone provided a massive, stable foundation of profit. But the real prize was the warrants. The warrants gave Berkshire the upside of common stock without the initial downside risk. As Goldman Sachs and Bank of America recovered, those warrants became immensely valuable, generating billions in pure, asymmetric profit. This entire structure of heads I win, tails I don't lose much was only possible because he had cash when no one else did. Liquidity is negotiating power. In a crisis, the person with the cash dictates the terms. For a personal investor, the effect is similar. Having dry powder allows you to dramatically lower your average cost basis in your best ideas. Imagine you own a stock you love at $100 a share. A market crash takes it to $50. The fully invested investor can only watch in horror. You, with your dry powder, can double your position at half the price, lowering your average cost to $75. When the stock recovers to $100, the other investor is merely back to break even. You are sitting on a 33% gain. This is not a small difference. Over an investing lifetime, this ability to aggressively average down during panics is a powerful engine of wealth creation. It is the tangible, mathematical result of choosing discipline over impatience and strategic patience over the fear of missing out. It is the financial reward for building your fortress before the war begins. Once you have correctly diagnosed the crisis and have the dry powder ready to deploy, the next critical phase begins. You must choose your targets. A crisis is like a storm that batters an entire fleet of ships. Not all of them will make it back to port. Some are old and rotten and will break apart in the waves. Others are poorly captained and will run aground. But a select few are built stronger, managed better, and will not only survive the storm, but will sail faster in the cleared seas that follow. This is the essence of the third pillar, identifying the survivors. A true contrarian investor does not blindly buy the entire sector that has been beaten down. That is a form of indexing, not intelligent stock picking. A true contrarian is a discerning hunter, looking for the specific companies with the resilience to withstand the gale force winds of a crisis and emerge with an even stronger market position. To understand this selection process, we must look at one of Buffett's longest-held and most profitable investments, the bank Wells Fargo. Buffett's love affair with Wells Fargo began long before the 2008 crisis. His initial large investment came in 1990. At the time, the banking industry was in turmoil. A commercial real estate collapse, particularly severe in California where Wells Fargo was dominant, had created a panic. Investors were terrified that banks would be buried under a mountain of bad loans. The headlines were screaming about an impending banking apocalypse. Bank stocks were being sold off indiscriminately. It was another moment of maximum pessimism, a perfect setup for a contrarian. But Buffett didn't just buy a basket of cheap bank stocks. He focused almost all of his capital on one, Wells Fargo. Why? Because he had done the deep, fundamental work to understand why it was different. He saw a survivor. His analysis, as detailed in his shareholder letters, was a masterclass in identifying a durable competitive advantage, or what he famously calls a, quote, moat. First, he looked at management. The bank was run by Carl Reichert and Paul Hazen, two managers he deeply admired. They were not your typical empire-building bank CEOs. They were relentless, fanatical cost-cutters. While other banks were building lavish headquarters and spending fortunes on corporate jets, Reichert was obsessed with efficiency, famously tracking the number of paperclips used in the office. This translated into a significant, sustainable cost advantage. Wells Fargo consistently had the lowest efficiency ratio, a measure of non-interest expenses as a percentage of revenue, among its major peers. This meant that in any given year, good or bad, more of each dollar of revenue dropped to the bottom line as profit. In a crisis, this efficiency was a powerful survival tool. Second, Buffett looked at the business model itself. Wells Fargo had a powerful and sticky franchise. It was focused on plain vanilla banking for consumers and small businesses in the American West, a region with strong long-term growth prospects. It didn't engage in the risky international lending or complex derivatives trading that got other banks into trouble. More importantly, its cost advantage allowed it to be more competitive on deposit rates and loan pricing, which attracted and retained customers. It had what Buffett called a, quote, commodity business with a low-cost producer advantage, akin to Geico in insurance. This was its moat. It was a simple, understandable, and highly profitable business that was difficult for competitors to replicate. Finally, he looked at the numbers through the lens of the crisis. He acknowledged the real estate problem was real and that Wells Fargo would have to write off billions in bad loans. The market was pricing the bank as if these losses would be fatal. But Buffett did the math. He looked at the bank's immense pre-tax, pre-provision earning power, the profits it generated before accounting for loan losses. He saw that this earnings engine was so powerful that it could absorb the anticipated real estate losses over a few years and still emerge not just solvent, but highly profitable. The market was focused on the storm. Buffett was focused on the strength of the ship's hull. He famously said at the time, "The banking business is no favorite of ours, but it's a business we know, and some of our greatest opportunities have come from an industry that is temporarily out of favor." He invested nearly $300 million, a huge sum for Berkshire at the time. That investment, held and added to over the decades, would grow into one of the largest and most successful in Berkshire's history, generating tens of billions of dollars in capital gains and dividends. He didn't predict the end of the crisis. He identified the company that was built to survive it. The psychological trap that Buffett sidestepped here is known as the narrative fallacy, a concept popularized by Nassim Nicholas Taleb. Our brains are story processing machines. We crave simple, coherent narratives to make sense of a complex world. When an industry is in crisis, the prevailing narrative is almost always a simple one of doom and gloom. For banking in 1990, the story was, real estate is collapsing, therefore all banks are going to fail. This story is easy to understand and emotionally compelling. Once we adopt such a narrative, we fall victim to another bias, confirmation bias. We actively seek out information that confirms our story and ignore or dismiss evidence that contradicts it. We'll read the scary headlines about loan losses and ignore the boring details in a company's 10K report about its efficiency ratio. Buffett's method is a direct antidote to this. He deliberately ignores the prevailing narrative and focuses entirely on the business fundamentals and the quantifiable facts. His approach to stock picking is not about finding a good story, it's about finding good numbers. He is looking for the exceptions, the data points, that break the simple, scary narrative. This requires a conscious effort to fight against our own brain's desire for a tidy story, and to embrace the messy, nuanced reality of individual business analysis. So, how can we replicate this discerning approach to finding survivors? We need a practical blueprint, a checklist, to guide our stock picking during a market crash. Let's call it the cockroach checklist, because we're looking for the companies that are tough enough to survive anything. Step 1. Scrutinize the balance sheet. This is non-negotiable. Forget the income statement for a moment. In a crisis, survival is about solvency. You must look for companies with low levels of debt, especially long-term debt. A company with a mountain of debt is fragile. A credit freeze or a dip in earnings can make it impossible to service that debt, leading to bankruptcy. Look for a healthy current ratio and a strong cash position. The balance sheet tells you if the company can play defense. Step 2. Vet the cash flow history. A company's reported earnings can be misleading due to accounting conventions. Cash flow is much harder to fake. Look for a long history of generating consistent positive free cash flow, even during previous recessions. This is the oxygen the business breathes. A company that consistently gushes cash has the resources to pay down debt, invest in its business, and ride out the storm without needing to tap external capital markets at an inopportune time. Step 3. Identify the moat. This is the Buffett signature. You must be able to clearly articulate the company's durable competitive advantage. Is it a powerful brand like Coca-Cola, a network effect like Visa or MasterCard, a low-cost advantage like Wells Fargo or Geico, or high switching costs like Microsoft? If you cannot identify a strong, sustainable moat, you are likely looking at a commodity business that will be forced to compete on price, a brutal place to be during a downturn. Step 4. Judge the captain. Evaluate the track record and alignment of the management team. Read their past shareholder letters. Are they honest about their mistakes? Are they prudent capital allocators, or do they chase growth at any cost? Do they have significant skin in the game through stock ownership? In a crisis, a skilled and rational management team is your greatest ally. A promotional or incompetent one can sink even the strongest ship. The antithesis of this disciplined approach is what we can call the basket case strategy. This is the path of the amateur contrarian who has learned just enough to be dangerous. They correctly identify that an industry is hated and cheap, but they lack the skill or the diligence to differentiate between the quality and the junk within that industry. They make one of two critical errors. The first is to buy the entire basket, often through an industry-specific ETF. While this provides diversification, it also guarantees that you will own the eventual losers and bankruptcies along with the winners, dragging down your overall return. You are essentially betting on the storm to lift all ships equally, which it never does. The second and far more dangerous error is to specifically buy the weakest players in the industry. The logic seems seductive. This stock has fallen the most, so it has the most upside when the industry recovers. This is the siren song of speculative ruin. Crises are a cleansing mechanism for the economy. They weed out the weak, over-leveraged, and poorly managed companies. The company whose stock has fallen 95% has usually done so for a very good reason. Betting on its recovery is not investing. It's a lottery ticket. Think of the airline industry during the COVID-19 pandemic. All airline stocks plunged. The basket case investor might have bought the one with the most debt and the oldest fleet because it was the cheapest. The disciplined survivor hunter would have looked for the one with the strongest balance sheet and best management, even if its stock hadn't fallen quite as much. The former was taking a massive risk. The latter was making a calculated investment opportunity. The direct financial connection of this survivor hunting strategy is the principle of market share consolidation. This is one of the most powerful and overlooked benefits of crisis investing. When a crisis hits, the weak companies go out of business. Their customers don't just disappear. They are forced to find a new provider. And they almost always flock to the strongest, most stable players in the industry. The survivor doesn't just return to its pre-crisis level of business. It emerges from the storm into a less competitive landscape, where it can capture the market share of its fallen rivals. This leads to a period of supercharged growth in the years following the crisis. Wells Fargo didn't just survive the 1990 crisis. It thrived afterward by absorbing the customers of the hundreds of smaller savings and loans that went bust. This creates a powerful double whammy for your investment returns. First, you get the benefit of the stock re-rating from its crisis-level depressed multiple back to a normal multiple. Second, you get the benefit of this accelerated earnings growth as the company consolidates its industry. This combination is what turns a great investment into a legendary 10-bagger investment. It's the tangible financial reward for having the diligence to sift through the wreckage and find the companies that are not just built to last, but built to dominate after the storm has passed. This is the essence of intelligent stock picking in the face of fear. We have now established the first three pillars. You have learned to diagnose the crisis, you have stockpiled the necessary capital, and you have developed a checklist to identify the most resilient companies. But all of this preparation is utterly worthless without the final, most challenging component, the raw courage to act. This brings us to the fourth pillar, overcoming the psychological warfare of contrarian investing. It is one thing to sit in a comfortable room and rationally decide that a stock is cheap. It is another thing entirely to click the buy button when the world is screaming that you are a fool, when your account balance is plummeting, and when every headline confirms your deepest fears. This is not a battle of spreadsheets and analysis. This is a battle against the deepest wired instincts of the human mind. To truly understand the intestinal fortitude required, we must place ourselves in the eye of the hurricane, October 2008. The date was October 16, 2008. It had been just over a month since the collapse of Lehman Brothers. The Dow Jones Industrial Average had experienced its most volatile period in history, with gut-wrenching single-day swings of 5, 7, even 10%. The global financial system was on life support, propped up by emergency government bailouts. The dominant emotion on a global scale was pure, unadulterated terror. The VIX index, Wall Street's fear gauge, was hitting record highs. Experts on television were seriously debating the possibility of a second Great Depression, the complete collapse of the banking system, and the end of capitalism as we knew it. In this environment of absolute panic, the New York Times published an op-ed piece. The title was simple and direct: "Buy American, I Am." The author was Warren Buffett. Imagine the scene. Your personal net worth, tied up almost entirely in businesses and stocks, has just declined by tens of billions of dollars in a matter of weeks. The companies you own are facing the most uncertain economic environment in 80 years. The news is relentlessly, catastrophically bad. And in that moment, you don't just quietly buy stocks for your company's account. You go public. You write an article for the most influential newspaper in the world, telling everyone that you are deploying your personal capital into American stocks. You are drawing a line in the sand. The piece was a masterpiece of calm, rational persuasion in a sea of hysteria. He acknowledged the fear, stating plainly, "The financial world is a mess, both in the United States and abroad." He didn't pretend the problems weren't real. But then he pivoted, shifting the focus from the short-term panic to the long-term reality. He wrote, "A simple rule dictates my buying. Be fearful when others are greedy, and be greedy only when others are fearful." He pointed out that the long-term prospects of America's great businesses had not been destroyed by the chaos on Wall Street. He stated his belief that their earning power would be far higher in the years to come, and that the market's fear was offering these future earnings at a ridiculously low price. He concluded with a clear declaration, "I've been buying American stocks." This was not just an investment decision, it was an act of psychological warfare. It was a public demonstration of courage designed to combat the prevailing narrative of fear. It required an almost inhuman level of emotional control. Think about the internal battle he must have been fighting. Even Warren Buffett feels fear, but he has developed the mental discipline to subordinate that fear to his logic. He knew that the single greatest enemy of the investor is not a bad economy or a volatile market. It is the investor himself. The op-ed was as much a message to himself as it was to the public, a reaffirmation of his core principles at the moment they were being most severely tested. He was not trying to time the bottom. In fact, the market continued to fall for another 5 months after his article was published. Anyone who followed his advice immediately saw their investments go down further. But that was irrelevant to him. His goal was not to be proven right in the next week or the next month. but to acquire excellent assets at prices that would all but guarantee excellent returns over the next decade. And in that, he was spectacularly right. His public stand in October 2008 marks one of the single greatest market calls in history, not because he picked the bottom, but because he had the courage to act decisively at the point of maximum fear. The psychological forces that make this action so difficult are immense, but two stand out: loss aversion and the pain of regret. Decades of research in behavioral economics, pioneered by Daniel Kahneman and Amos Tversky, have shown that the human brain is wired to feel the pain of a loss approximately twice as powerfully as the pleasure of an equivalent gain. Losing $100 feels as bad as winning $200 feels good. When you buy a stock in a falling market, you are setting yourself up for an immediate, painful experience. The stock is likely to go down further before it goes up. Every tick down is a small paper cut of loss, and your loss-averse brain screams at you that you've made a terrible mistake. It is an excruciating psychological experience. This is compounded by the fear of regret, specifically the social pain of looking like a fool. If you buy a stock and it goes down, you have to admit, to yourself and potentially to others, that you were wrong. It's much easier socially and emotionally to do what everyone else is doing. If you sell with the herd and the market keeps falling, you can comfort yourself by saying, well, everyone was selling. If you sell and the market recovers, you can say, no one could have seen that coming. But if you buy against the herd and you're wrong, the failure is yours and yours alone. This fear of being a conspicuous failure paralyzes the vast majority of investors. They are terrified of the potential for regret. To overcome these powerful forces, you cannot rely on willpower alone. You need a systematic, pre-planned operational framework. You need a contrarian's creed to guide your actions when your emotional brain is trying to hijack the controls. Step 1. Pre-commit to your plan. The most important decisions must be made in peacetime, not in the heat of battle. Before the crisis hits, when you are calm and rational, you must write down your action plan. Identify the stocks you want to buy, the prices at which you find them attractive, and the amount of capital you will allocate to each. If company X, which I have researched and believe in, falls to price Y, I will invest Z dollars. This transforms the decision from an emotional one, should I buy now? It feels so scary, to a simple binary one. Has my predetermined condition been met? Yes or no. You are essentially giving orders to your future, emotional self. Step 2. Execute with staggered buys. Do not try to be a hero and time the absolute bottom. It is impossible. Instead, buy in tranches. If you have decided to invest $10,000 in a stock, divide it into 3 or 4 parts. Buy the first tranche when it hits your initial price target. If it falls another 10 or 15%, buy the second. This approach accomplishes 2 things. Psychologically, it mitigates the pain of buying and immediately seeing a loss. In fact, if the stock falls further, you can welcome it as an opportunity to buy your next tranche at an even better price. Financially, it improves your average cost basis, ensuring you don't blow your entire load at a false bottom. Step 3. Institute a news blackout. During a market panic, the financial media is not your friend. Its business model is to attract eyeballs, and nothing attracts eyeballs like fear and sensationalism. Consuming a constant diet of financial news during a crash will only amplify your anxiety and tempt you to abandon your plan. Once you have made your investment based on your research, unplug from the noise. Focus on the business fundamentals, not the daily price quote or the latest scary headline. Step 4. Find an accountability partner. Share your written-down, pre-committed plan with a trusted friend, family member, or mentor, someone who understands your strategy. Their job is to be your logical backstop. When you are tempted to panic, you call them, and their job is simply to ask, "What did the plan say? Are you sticking to the plan?" This external voice of reason can be invaluable when your own internal voice is screaming in terror. The antithesis to this disciplined courage is the most common and costly mistake in all of investing: waiting for confirmation. This is the path of the 99%. The investor who falls into this trap is too scared to buy when the news is terrible and the market is falling. They tell themselves, "I'll wait for things to calm down. I'll buy when there are signs of a recovery. They are waiting for a confirmation signal. Some good economic news, a positive earnings report, or a few strong up days in the market. The problem is that by the time this confirmation arrives, the best prices are long gone. The market is a forward-looking mechanism. It bottoms out and begins to recover months before the economic news turns positive. The greatest bargains are only available when the news is at its absolute worst, when uncertainty is at its peak. The investor who waits for the uncertainty to pass has missed the entire point of contrarian investing. They end up buying after the stock has already run up 30, 40, or 50% from its lows. They get a fraction of the returns and take on more risk, as the price is now further from its rock-bottom valuation. They have successfully avoided the emotional pain of buying in a downturn, but they have paid a tremendous price for that comfort in the form of lost profits. They chose emotional safety over financial opportunity. The direct financial connection here is the concept of the courage premium. In efficient markets, risk and return are related. However, in times of panic, markets become inefficient. The price of an asset no longer reflects its rational, discounted future cash flows. Instead, it reflects the raw, emotional state of the sellers. The price becomes a function of fear. When you step in and buy during this period of maximum fear, you are not just an investor. You are a liquidity provider to a panicked market. You are providing the one thing everyone wants, cash, in exchange for the one thing nobody wants, a volatile asset. For providing this service and bearing the emotional discomfort of going against the herd, the market pays you a premium. This courage premium is the difference between the panic-induced price you pay and the rational value of the asset. It is the source of the excess returns that are available during market crashes. Your willingness to endure psychological pain is directly converted into financial gain. Every time you overcome your loss aversion, every time you ignore the screaming herd and stick to your pre-committed plan, you are earning this premium. This is how beating the market is achieved. It isn't about having a higher IQ or a secret formula. It is about having a superior psychological temperament and the operational discipline to execute your strategy when it is hardest to do so. It is the financial reward for winning the war that is waged not on a trading screen, but in the 6 inches between your own ears. You've done it. You have navigated the storm. You diagnosed the crisis, deployed your reserve capital, identified a survivor, and had the sheer courage to buy when everyone else was selling in a panic. You are now the proud owner of a wonderful business, purchased at a ridiculously attractive price. Many investors would now be tempted to declare victory. But the final, and perhaps most deceptively difficult phase of the journey is just beginning. The greatest fortunes are not made simply by buying low. They are made by holding on. This leads us to our 5th and final pillar, the long-term harvest, patience beyond the panic. Buying at the bottom is an event. Wealth creation is a process. The process requires a form of patience that runs counter to every instinct of the modern hyper-connected world. To truly understand this principle of profound, almost stubborn patience, we must look at one of Buffett's earliest and most formative investments, a company that tested his resolve for years before it became one of his greatest triumphs, the Washington Post. In 1973, Warren Buffett began accumulating a massive stake in the Washington Post Company. On the surface, it was a classic Buffett investment. The Post was a dominant newspaper in a major city, giving it a powerful local monopoly, a deep moat. It was run by Katharine Graham, a CEO he deeply trusted and admired. And most importantly, the stock market was in a funk, and newspaper stocks, in particular, were unloved and undervalued. He calculated the intrinsic value of the business, including its newspaper, television stations, and other assets, to be around $400 million. Yet, the stock market was valuing the entire company at just $80 million. He was able to buy pieces of a $400 million business for an $80 million price tag. It was a textbook example of value investing. He invested nearly $11 million, a huge portion of Berkshire's capital at the time, to acquire more than 10% of the company. And then, the pain started. The market did not immediately recognize the wisdom of his purchase. In fact, it did the opposite. The bear market of 1973-74 deepened, and the stock of the Washington Post, along with the rest of the market, got crushed. Over the next 2 years, the value of Buffett's investment fell by nearly 50%. Imagine the psychological pressure. You have made one of the largest investments of your career, and within a short period, you are looking at a paper loss of more than $5 million. Every day, the market is telling you that you are wrong. Your investors are questioning your judgment. Your own brain is second-guessing the decision. This is the moment where most investors, even those brave enough to buy in the first place, would have cracked. They would have sold, perhaps to cut their losses, or simply to end the psychological torment of watching the price fall. But Buffett did not waver. Why? Because his conviction was not based on the stock price. It was based on his deep analysis of the underlying business value. He knew the business was still worth $400 million, regardless of whether the market quoted it at $80 million, $60 million, or $40 million. The daily fluctuations of the stock market were, to him, the manic-depressive ramblings of an irrational business partner, whom he famously called Mr. Market. He completely divorced the performance of the business from the performance of the stock. He focused on what mattered. Was the Washington Post still dominating its market? Was its circulation strong? Were advertisers still paying up for space? Was K. Graham still running the company effectively? The answer to all of these questions was yes. The business was performing well, even as the stock was performing terribly. And so, he held on, and he held on, and he held on. For years the stock did very little, but slowly, inevitably, the market began to recognize the immense value he had seen. The stock began to rise. And then it soared. That initial $11 million investment, which caused him so much short-term pain, grew in value to over $1 billion over the subsequent decades. It became one of the cornerstones of Berkshire Hathaway's empire, a more than 100-fold return. This legendary outcome was not secured on the day he bought the stock. It was secured in the lonely, difficult years that followed, through the simple, but not easy, act of doing nothing. The psychological bias that makes this patience so difficult is a powerful combination of myopic loss aversion and action bias. Myopic loss aversion is our tendency to feel the pain of short-term losses much more acutely when we check our portfolios frequently. If you check your stock prices every day, you are subjecting yourself to a constant stream of mostly random, negative feedback, triggering your loss aversion over and over again. This creates a state of chronic anxiety and a powerful urge to stop the pain by selling. Compounding this is our inherent action bias. When faced with a problem or uncertainty, our brains have a deep-seated need to do something. Sitting still and being patient feels passive and irresponsible. We believe that taking action, any action, is better than doing nothing. This is why investors are constantly tinkering with their portfolios, selling one stock to buy another, a process known as churning. They feel like they are being proactive and in control. But study after study shows that the more an investor trades, the worse their returns are. Buffett's patience is a conscious rebellion against these two biases. He rarely checks stock prices. He focuses on long-term business results which are reported quarterly, not second by second. And he has a profound appreciation for the power of inactivity. He famously said, "The stock market is a no-called strike game. You don't have to swing at everything. You can wait for your pitch." The same applies after you swing. You don't have to run around the bases frantically. You let the home run travel its full distance. To cultivate this kind of radical patience, we need a mental model to guide our post-investment behavior. Let's call it the gardener's mindset. A gardener does not plant a seed and then dig it up every day to see if it's growing. They trust the process. They provide the right conditions and then they wait patiently for the harvest. Step 1. Shift your focus from price to performance. Once you have purchased a stock, your primary focus must shift away from the daily stock quote. Your new dashboard should be the company's quarterly and annual reports. Are revenues and earnings growing as you anticipated? Are profit margins stable or improving? Is the management team executing on its stated strategy? You are no longer a stock picker. You are a business owner. Judge your investment by the progress of the business, not the whims of Mr. Market. Step 2. Establish a time-based review schedule. To combat the urge to constantly check prices, create a formal, calendar-based review process. Decide that you will only review your portfolio and your individual holdings once a quarter or even once a year. This enforces discipline and prevents you from making emotional decisions based on meaningless short-term noise. Step 3. Predefine your exit criteria. The decision to sell a stock should be as logical and pre-planned as the decision to buy it. Before you even make the purchase, write down the conditions under which you would sell. There are generally 3 good reasons. First, you might sell when the stock has reached your estimate of its full intrinsic value and you have better opportunities elsewhere. Second, you would sell if your original investment thesis is proven wrong. For example, if the company loses its competitive advantage. Third, you might decide to hold it forever, as long as it remains a great business. By defining these criteria in advance, you prevent yourself from making a panic sale based on fear, or a premature sale based on greed. The antithesis of the gardener's mindset is the behavior of the profit snatcher. This is the investor who has the courage to buy in a crisis but lacks the patience to see the investment through. They buy a stock at the bottom, and as the market begins to recover, the stock quickly jumps 20 or 30%. Feeling a sense of relief and a flush of vindication, the profit snatcher immediately sells to lock in a gain. They feel clever. They have successfully bought low and sold higher. But in reality, they have committed a massive financial blunder. They have mistaken the first green shoots of spring for the full summer harvest. They picked the apple when it was a tiny green bud, leaving the entire mature fruit to be enjoyed by someone else. They turned a potential 10-bagger into a measly 30% gain. This behavior is driven by a fear of round-tripping, watching a profitable position go all the way back down to their purchase price. To avoid the potential pain of giving back their small gain, they sacrifice the potential for a life-changing, massive gain. It is a classic case of prioritizing short-term emotional comfort over long-term financial optimization. The direct financial connection of long-term patience is the 8th wonder of the world, as Einstein supposedly called it, the power of compound returns. The truly spectacular, wealth-creating returns in investing do not happen in a straight line. They follow an exponential curve. The initial bounce off the bottom of a crisis is just the beginning. The real magic happens in the years that follow, as a great company, purchased at a bargain price, continues to grow its earnings, and those earnings are reinvested and compounded year after year. The Washington Post investment illustrates this perfectly. The move from a $40 million market cap back to its $80 million purchase price was a 100% return, a fantastic result. But the move from $80 million to over $1 billion in the subsequent years is where the real fortune was made. That is the power of compounding. By selling early, the profit snatcher completely truncates this exponential curve. They capture the linear part of the return and miss out on the explosive, geometric growth that follows. This is the mathematical difference between making a good return and achieving true, generational financial freedom. Patience is the fuel for the compounding engine. Without it, you are constantly starting over, trying to find the next short-term trade. With it, you allow the greatest force in the financial universe to work its magic for you, turning your courageous crisis investments into the bedrock of a financial legacy. You have just been given a powerful piece of intellectual machinery. You have received the blueprint for one of the most effective wealth creation strategies ever devised. The art of turning widespread fear into personal opportunity. We have dissected the 5 core pillars of Warren Buffett's crisis investing philosophy, from identifying the opportunity and preparing your capital, to selecting the survivors, summoning the courage to act, and finally, having the patience to see it through. This is more than just an investment technique. It is a complete mental framework, a CEO mindset for navigating a world of uncertainty. You now possess a tool that the vast majority of market participants will never understand, a tool that can allow you to systematically profit from the predictable patterns of human emotion. You have invested your time, and in return you have acquired a durable intellectual asset that can serve you for the rest of your life. But it is crucial to understand that what you have just learned, as powerful as it is a single, critical piece of a much larger, interconnected system. Warren Buffett's success is not the result of one single trick or mental model. It is the result of a latticework of models, a complex mental arsenal where each principle supports and strengthens the others. The contrarian strategy we've explored today is powerfully amplified when combined with his methods for calculating intrinsic value, his techniques for analyzing competitive moats, and his philosophy on capital allocation within a diversified portfolio. You have mastered a crucial link in the chain, but the chain itself is far stronger. You have been given a detailed map of one continent, but there is an entire world of knowledge left to explore. The video that is now appearing on your screen is not a random suggestion, it is the next piece of that map. It is the link that connects the strategy you've just mastered to another, equally vital component of this intellectual arsenal. Think of what you've learned today as the powerful engine of a race car. The video on your screen is the chassis, the steering, the very system that allows you to control that power and navigate the complex turns of the market. To stop now would be like building that engine and leaving it on the factory floor. The true power is only unleashed when the pieces are connected, when the system works in harmony. The choice to click is not about watching another video. It is a declaration of your intent. It is a choice to continue your ascent, to move beyond being a passive spectator of financial markets and become an active, intelligent architect of your own financial future. The question is not whether the information has value. The question is whether you are the kind of person who is committed to completing their mental toolkit, the kind of person who doesn't stop when they've learned one thing, but who pushes forward until they have achieved true mastery. Complete the system, continue the journey, click the video.